down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
We're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
The NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stock trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it. It's so horrible.
Welcome back to the channel. Today we're going to be looking at risk, or at least how to limit risk. Now, risk is the chance or probability of the loss of capital. Now, risk can vary specific to each investment, so it's important to understand the risks of every investment. Exposure to risk will be harmful to your portfolio, your money, if you don't take proper steps to manage risk. Now, I don't know about you, but I enjoy not losing money. Types of risk include interest and credit risk, inflation, liquidity, market or commodity and trade values, business volatility, risk specific to each company or chance of default, political or industrial problems, the concentration in your portfolio of a specific company, and the performance of the specific equity that you're investing in. Now, there are multiple ways to limit each of these risks, so we're just going to name a few. To limit risk due to interest or credit. Credit is essentially the borrowing of money to maximize returns. It can also be known as leverage. You pay back more than a minimum amount so as to not incur interest and expense risk. Or you can simply not borrow money if you don't know how to invest it in the first place. Borrowing someone else's money to lose it, probably not a good idea. To fight inflation risk, you can invest. Liquidity, you can buy high volume companies, so companies that are frequently traded. Tesla, Google, any Fortune 500 companies, prime examples. Now, we'll get into this later in future episodes, but a lot of smaller companies do have higher potential upsides simply because there's not as many people watching those companies. So the next risk is the market or commodity and trade risk. Now these risks happen because commodities, so for example, coffee, iron, coal, specific to each industry might decrease in value. So an example is recently, because of this whole Russian oil problems and they're blowing up supply lines, and so essentially the price of oil has increased, and as a result a lot of drilling companies are worth more now. You can see this simply by going on to FinViz or Yahoo Finance and just looking up oil companies. So that can be one cause of risk. Now, obviously, if a commodity drops in price, then you would see the share price of the company that trades those commodities or creates those commodities go down in value. A way to hedge against market or commodity trade risk is by diversifying your portfolio or hedging. We'll get into hedging in a later video. Another risk is the business or volatility of the business. For example, S&P 500 index is probably less risky than Tesla, and then a company that would have even greater volatility is another word for daily fluctuation, would be MGNA, which is a small marijuana selling company. Obviously, they're going to be volatile, they're a smaller company, and they're in a more competitive market with higher upsides relative to their size. So another risk is to look at the specific company risk. And both business and specific company risks can be hedged against or limited by looking at the 10Ks of the business, which you can find on the SEC. Essentially, I'll teach you about these fundamentals and valuing a company in future episodes, so just take this part with a grain of salt until you watch the next video. Political and industry risk can be solved with keeping up with the news and diversifying your portfolio. Concentration risk is literally you're dumping all your money into one stock. Just don't do that. Buy some other companies that have different types of risk. So don't buy a bunch of companies all in, say, shoe retail. Buy some from each individual sector or industry. We'll get into that in a later video as well. Performance risk also has to do with the business. It essentially is based off of, poor management of the company. All of that can be looked at and read by looking at the business's 10K reports on the SEC. If you don't know how to do that, I'll show you in later videos. And another thing you can do to limit against performance risk is by not buying growth stocks and instead buying value stocks, value companies. So the next thing we're going to look at is volatility. Volatility can basically ruin your portfolio. However, volatility is not necessarily risk. Volatility, as mentioned, is the daily fluctuation in price value of a company. Now again, S&P 500 ETF would have less volatility than the tiny marijuana dealing company MJNA. Now, blindly buying a stock with no risk management is essentially gambling. It's speculation. So let's say Tesla is growing, and we know that it's the next biggest car company. It's selling electric cars faster than Elon Musk is buying Twitter. So essentially, because so many people are looking at Tesla, the price of Tesla is essentially priced in. It's a fair value for Tesla because there's so many people constantly assessing the value of it and looking at its 10K reports, annual reports. There's so many analysts that know what Tesla is worth or can at least try to estimate it. Now currently Tesla is assuming high growth. Their share price is like $220 right now, and that's assuming that their sales increase for the next couple years at 30% until they reach Apple's highest year of earnings, which is like $90 billion. So it's not sustainable, but that's why Tesla is considered a growth stock, is because they're assuming that it's going to have high growth, and that's why the company is valued so expensively. Also, another example of speculation and why it fails is because you might say you want to buy Tesla, but again, the share price is priced in. They're already a high growth company. They're probably not going to grow as much as what people assume they will, and they have a relatively high debt to equity ratio. So they're using a lot of leverage. About every dollar invested is equal to 82 cents of debt, from shareholder equity to liability. So this essentially means that Tesla is pretty well leveraged and they're using a lot of debt and credit. So they do incur a lot of credit risk, which was a risk that was previously mentioned. So their industry would be relatively competitive because they have to take on such high risks. For an example, Ford, which is not necessarily a growth company, it would be considered a value company, is trading at $12 per share, but has an earnings of $3 per share. Whereas Tesla is $205, and they only earn $3 per share. So for literally like 1/10, 1/15 of the price, you can get just as much earnings per share with Ford than you could with Tesla. So in the next video, we will look into how we can use value investing to maximize gains and minimizing risk, and why other strategies fail. See you in the next video. Hope you enjoyed the video. Go ahead and like and subscribe.